Hey everyone, welcome back to Corporate Decoder, the place where we take dry corporate documents and turn them into something you can actually understand. And maybe even find a little juicy. Today we're diving into ENCISION Inc's proxy statement, and let's just say they've got some interesting things they want to tell their shareholders about their upcoming meeting. So what's this document all about? It's basically ENCISION Inc. telling its shareholders when and where their annual meeting is and what they'll be voting on. Think of it as the invitation and agenda for their big shareholder party. This year's meeting is set for August 21st, 2025, and it's happening at their headquarters in Boulder, Colorado. First up on the agenda, they need to elect 4 new directors to their board. This is pretty standard stuff where shareholders get to choose who's making the big decisions for the company. Next, they're looking to approve their auditors, a firm called Green Growth CPAs. Basically, shareholders are voting to make sure the company's books are being checked by someone independent and trustworthy. This is where it gets interesting. They're asking shareholders to vote on their executive pay. Now, this vote isn't binding, meaning the company doesn't have to do what the shareholders' sentiment. Think of it as a really important review. Then following up on that, they want shareholders to decide how often they should be voting on executive pay in the future. Should it be every year, every 2 years, or every 3 years? It's like asking shareholders whether they want a regular performance checkup or a less frequent but more in-depth review. And of course, they've got that catch-all for anything else that might pop up tacky now. Let's shift gears and look at who's actually steering the ship. The report gives us a rundown of their directors. We have Vern D. Cornelison, who's been around since the early days and seems to have a strong financial background. Then there's Robert H. Fries, described as a founder of another company and a seasoned executive. Dr. Patrick W. Pace brings a lot of experience from the world of private equity and healthcare. But of course, Gregory J. Trudell, who's not just a director, but also the president and CEO with a ton of experience in medical devices. This section is about how much they pay their directors. The independent directors get a quarterly fee of 1/250/50s, and their expenses are covered. The table here breaks down the compensation for the fiscal year 2024. Robert H. F. Fries received a total of $67,705. Vern D. Cornelison got $720.43, and Dr. Patrick W. Pace earned $14,778. It's good to see that some of the directors are getting a decent chunk of their compensation in cash, but there's also a significant portion in equity, meaning their pay is tied to the company's stock performance, which aligns their interests with shareholders. We Ortseg freighting a decent chunk of their compensation in cash, but there's also a significant portion in equity, meaning their pay is tied to the company's stock performance, which aligns their interest with shareholders. And here's some more equity talk. Outstanding options for directors at the end of fiscal year 2024. Robert H. Fries has quite a few options, as does Vern D. Cornelison and Patrick W. Pace. This means they have the potential to benefit if the company's stock price goes up, which is a common way to incentivize management and directors. Now let's talk about the big kahunas, their executive officers. This table shows us what they earned in the last 2 fiscal years, 2024 and 2025. For the CEO, Gregory J. Trudell, his salary was around $253,000 in 2025 and $264,000 in 2024. He also received some option awards, bringing his total compensation to over $300,000 in 2025. Brian J. Jackman, the VP of Marketing, made about $155,000 in salary in 2025, with a total compensation of around $166,000. And Jason E. Johnson, the VP of Sales, earned a salary of about $194,000 in 2025, with a total compensation of roughly $200,000. These numbers seem pretty reasonable for the heads of these departments. This table is crucial because it tries to link how much the executives are paid with how the company performed. It's pretty technical, showing compensation actually paid versus things like total shareholder return and net loss. For example, the value of a $100 investment over 3 years based on their total shareholder return was $75.25 and $75.24. This means if you invested $100 back in 2021, you'd have either $70 or $75 back in 2021. You'd have either $70 or $75 back by now. That's not exactly a home run, but it's not a total disaster either, especially considering the next number. The company actually reported a net loss of over $220 million in 2025 and a whopping $691 million in 2025 and a whopping $690 vote. This part of the pay versus performance table gets into the nitty-gritty adjustments to calculate compensation actually paid. For the CEO, it went from over $138,000 down to about $2,084 for the other executives. The average compensation actually paid went from around $158,000 in 2024 to about $188,000 in 2025. It's a bit of a mixed bag here. The company explains that their equity compensation, like stock options, is designed to align executive pay with shareholder experience. They say their total shareholder return decreasing slightly over the last couple of years reflects this alignment. However, they also admit that compensation isn't directly tied to net income or loss, which, given those massive reported losses, is definitely a point of concern for investors. They've got an employment agreement with their CEO, Greg Trudell. It lays out his base salary, which has been increasing, and bonuses tied to revenue and net income growth. The bonus structure sounds complicated, but the gist is that a bigger chunk aims to go to the CEO the better the company performs financially. This table shows stock options granted to executives in fiscal year 2025. Greg Trudell received options, and so did Brian Jackman. This is standard practice to incentivize executives and tie their rewards to the company's stock value. And look, both Greg Trudell and Brian Jackman exercised some of their stock options in 2025. This means they bought shares at a lower price than the current market value, making a good profit. And lastly, on the executive compensation front, this table shows all the unexercised options for the named executives at the end of fiscal year 2025. Gregory Trudell, Brian Jackman, and Jason E. Johnson all still have significant numbers of options available, which could be worth a lot if the company's stock price recovers. Moving on to who actually owns the company, this table shows the big shareholders as of June 23rd, 2025. Vern D. Cornelson seems to be a major player, directly owning a lot of shares and indirectly through CM Partners LLP. He's sitting on nearly 28% of the company. Robert H. Fries also holds shares, though a smaller percentage. Our CEO, Gregory J. Trudell, has a decent stake too, around 228%. And then you have CM Partners LLP, which Mr. Cornelson is the general partner of, holding another over 27% chunk. That's a lot of control in a few hands. There are also institutional investors like Daffer Capital Management and others, each holding significant percentages, showing that outside money is also betting on ENCISION. Remember Robert H. Fries, the director and consultant? In fiscal year 2025, the company paid nearly $41,000 to an entity controlled by him for financial and tax consulting services. This is a related party transaction, and while it might be perfectly legitimate, it's always something to keep an eye on, as it involves money flowing between the company and its own board members. Now back to that auditor vote. They're proposing to keep Green Growth CPAs for fiscal year ending March 31, 2026. There were also their auditors for the previous year. The audit fees for Green Growth CPAs in fiscal year 2025 were $74,750. It's good to see that the company is transparent about these costs. This is that say on pay vote we talked about earlier. They're asking shareholders to approve the compensation of executives as disclosed in the report. Again, it's advisory, but it's a big indicator of shareholder satisfaction with how the company rewards its leaders. So this proposal is about how often shareholders get to weigh in on executive pay. The board recommends voting for a frequency of every 3 years. They argue this allows for direct shareholder input on compensation philosophy over time. So what's the big picture here? ENCISION Inc. seems to be navigating a challenging financial period with significant net losses in recent years, while the executive compensation appears somewhat aligned with the company's stock performance through equity awards. The actual pay levels, especially for the CEO, raise questions when viewed against the backdrop of these substantial losses. The concentration of ownership among a few major shareholders, particularly Vern D. Cornelson and CM Partners LLP, suggests that significant decisions are likely to be heavily influenced by their interests. The company is clearly trying to manage its performance and communicate its strategy to shareholders through this proxy statement, but the underlying financial health is a major factor that will shape the vote on executive compensation and the company's overall direction. That's our deep dive into ENCISION Inc.'s proxy statement. What are your thoughts on their executive compensation and the upcoming shareholder vote? Let me know in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more corporate insights. And don't forget to join our Discord community linked in the description for more discussions. Thanks for watching, and we'll see you next time on Corporate Decoder.